What up, investors? It's February 9th, and we're going to go over the Walt Disney Company Q1 2023 earnings, numbers, conference call, and all the details. We're going to dive into it, okay? You heard, of course, Q1 2023. These guys have a lopsided fiscal year calendar, so most companies are normal, just your same calendar year, Q4, but this is Q1 2023, okay? When companies are reporting, or the majority of companies in March are reporting Q1, these guys are going to be reporting Q2 2023, okay? So I also have a lot to talk about when it comes to Uber. I have another Uber video coming. There was 3 other companies that reported today: Corsair, Callaway Golf, Topgolf Callaway Golf, and PayPal reported today. So I'm far behind on these earnings videos, okay? So just be patient with me, but let's get going on the Walt Disney Company. So here we go. Let's get on with the numbers, and we'll start with the numbers. I usually explain what the company does, but you know what Disney does. Everybody who watches this video or has anything to do with any Disney products, parks, you know what Disney does. I'll break it down in a little bit because I've done it before in a prior video, okay? But the earnings, very good earnings in comparison to what was expected, okay? So big beat on the EPS. We're looking at 99 cents adjusted versus 78 cents expected. That's a beat of 21 cents. That's a gigantic beat for Disney, specifically compared to the last quarter where they reported where they missed by about 15 cents. Very good number here. Very good recovery of that EPS profitability. Now, revenue 23.51 versus 23.37 expected. That's a nice beat as well. And then other expectations. Disney always watches, because it's a streaming platform now with Disney Plus. There's a lot of watch on subscribers and DTC subscribers, active DTC subscribers. DTC, of course, direct-to-consumer subscribers for Disney Plus. And ARPU, Disney Plus ARPU, which is annual revenue per user. Okay, so you can see here pretty good beats on these two, on the subscriber and active subscriber growth and active subscribers. And ARPU, of course, that's a miss there. Nothing too surprising about a miss as far as the profitability of Disney Plus. Everybody knows it's not profitable. The street is very well aware of this, okay? It's about taming down those losses and getting to the path of profitability. We'll talk a little bit about that later, okay? The guidance, I couldn't find a lot about the guidance, which is kind of surprising, okay? There's no more long-term subscriber growth guidance, and that is good in my opinion. That shows the shift into a profitability mindset instead of a growth at all costs mindset. That's definitely what the street and myself wanted to see. And Disney Plus profitability by the end of fiscal year 2024. So that's a goose egg. I mean, that's really nothing to fret about on the guidance. We'll keep it going, okay? Now, this is the same slide I had on my last video that I did about Disney. I'll drop a link there if anybody wants to see it. It was a Q2 2022 earnings video, if I remember correctly. I'll drop the link here so you guys can see, but it just goes over the business segments, okay? However, there's going to be a reorganization of these segments and the way that they're reported to Wall Street, to investors, okay? And we'll talk about that, but first, we'll talk about the tale of two Bobs. Anybody who follows this stock and anybody who saw CNBC today, I mean, if you saw CNBC today, let me show you guys this. And this is CNBC on YouTube. You can kind of follow on the videos tab for CNBC, sort of like the business day. It just follows the business day, essentially what the business day does. But you can see here, you got Disney here, Disney all over the place. We had some breaking news about Pels. We'll talk about that in a little bit. And just Disney all throughout the day. I mean, everywhere, all throughout the day, talking about Disney on CNBC. Like, they were obsessed with Disney today on CNBC. Now, going back to the tale of two Bobs, okay, we have Bob Iger, which is the legendary CEO of Disney from 2005 to 2020. This guy's 72 years old, guys. So he's no spring chicken, okay? 72 years old. He's stepping back in to fix the mistakes of the bad Bob. Bob Chapek is his name, who was ousted after last quarter and the earnings of last quarter, which were abysmally bad. So this guy cannot execute. This guy is known for excellent execution. So glad to see him back as a shareholder. Definitely a positive. This guy is a gangster, godfather, whatever you want to call him. He is the man. So essentially, we trust in Bob Iger to get us back to a profitability, sort of platform with Disney Plus and also the parks and an all-around return of the dividend. We'll talk a little bit about that later. Okay, now I did put Peltz right over here. Peltz is from Trian Partners Investing, okay? And I'll show you guys this here. This is their portfolio, and I was trying to see if Trian Partners had any of the same stocks that I own, but no. The only stock that I own with them in common is Disney. But this guy came in to try to oust a board member and sit on the board of Disney to try to get them to do what Bob Iger just did in reorganizing Disney. And I'll give you an example here. This is what I was listening to this morning on SiriusXM radio after I dropped off my daughter to school. Let me show you guys this. And here's the video this morning. Of course, I listened to this on the radio. This is the video this morning from Squawk on the Street on CNBC. Here's Jim Cramer, Jimmy Chill, talking to Nelson Peltz from Trian Partners about what Bob Iger just said in the conference call and how he feels about it. Let's listen to this real quick.
I'm bringing in to find out an instant reaction to what David just got with Bob. Nelson, is this one of those where you just declare victory? How you doing?
Okay, Jim, how are you?
Well, my charitable trust owns Disney. I like what I heard. I really like what I heard, Nelson.
These are exciting times. You know, Jim, my dad once told me that you can only win once.
Stock went
this
down
was
back to like
a great win
12,
for all the shareholders. Management at Disney now plans to do everything that we wanted them to do. We wish the very best to Bob, his management team, the board. We will be watching. We will be rooting. And the proxy fight is over.
Yes. Thank you for declaring victory in a gracious way.
Okay, so that's Jim Cramer saying yes because he got the breaking news, right? He got the live breaking news. So of course, as a reporter and all that stuff, they get a ton of credit for breaking news live on the air. So good for them. But it was funny this morning hearing that on the radio as a Disney shareholder to just hear it in real time saying, "Hey, the fight's over." Great, that's another positive on the stock. It's a short-term positive, so it's short-lived. It's nothing that now is priced into the stock. Okay, so let's move on. Now let's talk a little bit about the strategic reorganization of Disney and how they're going to report their business segments from now on. So we have the parks or Disney Entertainment, which includes media, Disney Plus, movies, etc., Disney Plus, Hulu, ESPN, headed by Jimmy Pitaro, and Disney Parks Experiences and Products. This is your theme parks, international, domestic, and cruise lines, okay? Now, the ESPN one being by itself is a little bit weird, in my opinion, because ESPN has been a drag on the stock forever. I always thought that this is something that they're going to spin off. There's a lot of talk about them spinning off ESPN, making it its own thing, or selling it to the highest bidder. There's a lot of talk about them not wanting to do that or no offers out there to do that, but I think that if the right offer presents itself, they will sell it if it improves the balance sheet significantly. So if that happens, expect ESPN to go to the wayside and no longer be a part of Disney. I wouldn't be surprised if I see that. Now, let's move on. Here's another slide on the reorganization. They're saying, hey, we're reorganizing leadership, cost reductions, working toward achieving sustainable growth and profitability. Major move here. Improving guest experience at our parks by providing more value and flexibility. We'll talk a little bit about this in a little bit because they are limiting attendance at certain parks in order to maximize the guest experience, but it will cost you more to do that, okay? Primarily focusing on significant investing in core brands and franchises. That's Marvel, Star Wars, also Avatar, the new Avatar movie. That's the focus there. And then leveraging our platforms to reach larger audiences and optimize the value of our content. So this one's a little bit of a balancing act of, hey, let's get the best customers, the most loyal customers that will give us the most money and make us the most profit. That's a balancing act that Bob Iger is going to have to deal with moving forward. Now, this is straight from the call here, and I wanted to highlight this because I think it's very important to talk about certain elements of the call because there's a lot that was said on the call that is very transformative, very important to understand for a Disney shareholder such as myself and you if you're a Disney shareholder, okay? So Bob Iger refers to three phases over, 20 years of Disney, okay? Which the first focus back in about 2005 to 2015 was focusing on great brands and franchises while embracing new technology, okay? That's Pixar, Marvel, and Lucasfilm, okay? There's also the Avatar movies that I don't think I mentioned there, but Avatar as well. Then the second phase was somewhere around 2016, in which Disney becomes a digital company with a plan to launch into streaming with their acquisition of 21st Century Fox, which ruined the balance sheet, by the way. It was overpayment. Anybody will tell you it's an overpayment for 21st Century Fox. And Disney Plus launch in 2019. And then now he goes on to say, now it's a time for another transformation, the one that rationalizes our enviable streaming business and puts it on a path to sustain growth and profitability while also reducing expenses to improve margins and returns and better positioning us to weather future disruption, increased competition, and global economic challenges. We must also return to creativity to the center of the company, increase accountability, improve results, and ensure the quality of our content and experiences. Then he goes on to say a little bit later, now the details. Our company is fueled by storytelling and creativity, and in virtually every dollar we earn, every transaction, every interaction with our consumer emanates from something creative. We always believed that the best way to spur great creativity is to make sure that people who are managing the creative process feel empowered, okay? This is going to be very important moving forward as far as the reorganization and sort of the shift of responsibility of financial success to the creative director, okay? Now, our new structure is aimed at returning greater authority to our creative leaders and making them accountable for how their content performs financially, okay? So essentially, if you're a creative director, you make a movie, you make a show for Disney Plus, you are accountable for how that content performs financially. So a lot of people talk about how Marvel movies or Star Wars movies, for example, I'll give you this example. I'm a Star Wars purist, right? I don't like 7, 8, 9, the new ones with Princess Leia flying across space and stuff like that. But this is essentially what that means, right? They're saying, hey, you're responsible for how your content performs financially, so you can't make a Star Wars movie for people like me that are purists only. You have to make sure that it satisfies a wide range of audience, including purists like myself, including new folks to the franchise, kids, whoever, etc., who may be interested in watching this movie. So you are responsible for a wide audience reacting to your story, to your creation, rather than just myself being, oh, it's a Star Wars movie and I want to go see it just because it's Star Wars, okay? And I want it to be like this, and I want it to be puppets instead of special effects. Hopefully that makes sense, okay? Now, our former structure severed that link, and it must be restored. Moving forward, our creative teams will determine what content we are making, how it is distributed and monetized, and how it gets marketed. Managing costs, maximizing revenue, and driving growth for the content being produced will be their responsibility. Okay, so again, you can be as creative as you can, but you have to have the money in mind. That's just part of the business, part of the balancing act of creating movies and shows. I want to touch a little bit here on the additional targeting of cost savings. And on the call here in the investor presentation, they're saying, hey, we're targeting $5.5 billion in cost savings. It's a reorganization, and here's pretty much the bread and butter of that, okay? There's $1 billion worth of savings that is already planned from last quarter, okay? But they are announcing layoffs, okay? 7,000 layoffs, which will come from labor here as part of the operational SG&A, and of course SG&A means selling. What does it mean? Selling, general, and administrative costs. So that's how they're trying to save money. They're going to let go of people, but it's important that you understand. It's always sad to see, especially as a shareholder. I don't want anybody to be fired, but Wall Street loves people getting laid off. I mean, look at Meta. Look at PayPal. Look at what other company just Dell. Dell just fired a bunch of people. Those stocks went higher when those layoffs were announced. Wall Street loves that, okay? But in context, in real context, 7,000 employees only reflects about 3% of the overall company. So if you think about it this way, out of 100 employees, they only got rid of 3. Sad, but necessary in order to keep the path of the business and keep the path of that management is envisioning for the future. Hopefully, these employees have some shares that will appreciate in the future and hopefully somehow offset their loss of work. Okay, now this is something that caught my attention that came straight from the call, which I thought was extremely important. Okay, we have to be better at curating the Disney and Pixar and Marvel and the Star Wars of it all as well. Okay, remember, these guys are just talking, kind of answering questions, and of course reduce costs on everything that we make, because while we're extremely proud of what's on the screen, it's gotten to a point where it's extraordinarily expensive, and we want all the quality. And it goes on to say other things about other different metrics, but that's the key word here for me. Making content has gotten extraordinarily expensive, and using technologies like the volume, and let me show you what that is real quick. Here's the technology, the volume by Lucasfilm. Okay, this is essentially a movie set in which you can project anything in 4K, like a desert. So if you watch The Mandalorian, the show The Mandalorian, these guys are using the volume to portray these vast dunes on Tatooine or space or all kinds of things. So all these folks here, working staff, actors, directors, people who make the food, who do the clothing, to do the makeup, they don't have to be transported by airplane to all these sets at a different point in the world. You know, beautiful to travel to these places like sand dunes, and then, you know, New Zealand and Ireland to make Andor, but it's a lot more cost effective, in my opinion, to make movies here rather than fly all these people and logistically maintain them for months at a time instead of just being here in San Francisco. All right, now that's all part of the savings and cost savings sort of, you know, value proposition that Bob Iger's trying to put together. I just want to give you a little bit of a visual on that. Now, here's some important stuff on the conference call, highlights specifically from Bob Iger. We got some highlights from the CFO coming right up after this, but I'm going to try to really skim through this really fast, okay? There's an extreme focus on profitability and growth. That's what we want to see from management. They focus more on core franchises. That means Avatar, Star Wars, Marvel, and then other movies, which we're going to talk about here in a second, okay? Full examination of promotional strategies, fine-tune all the initiatives on all streaming platforms. So they're saying, hey, wherever we can trim the fat, we will trim the fat, okay? We're going to take anything that's not necessary and just get rid of it in favor of profitability. Creative directors have direct control over the content, but will be held responsible for its financial performance. A little bit of Darth Vader in there, kind of like, you, director, are responsible, otherwise, you know, you will feel my wrath, kind of thing, you know, kind of like a Darth Vader little monologue, okay? Number one priority is the success of streaming biz and return it generates for shareholders. That's excellent. This is actually said exactly like that on the call. Number one priority is the success of the streaming business, okay? Because if Disney Plus becomes anything profitable like a Netflix is, then this stock goes to the moon, okay? And that's why we are investors in the stock, okay? Avatar, Way of the Water, becomes the 4th biggest box office success of all time, $2.2 billion worldwide. Amazing. They announced a new Avatar experience at Disneyland Anaheim. Black Panther, one of the most successful launches on Disney Plus. And then an upcoming movie slate. And I'll tell you here, the movie slate can also be seen on the investor presentation on the investor relations website. I'll show you a little bit here. But here you have the earnings presentation. You can scroll through all this and a bunch of stuff that I'm talking about already. But here somewhere is the slate. Here we go. Disney Plus, Hulu, theatrical releases. You can see all the theatrical releases and all the upcoming Disney Plus and Hulu releases. Theme parks and what they're opening. New experiences, new rides. All there on the investor presentation on the site. But of course, let's focus on the big money makers. So we got Ant-Man and the Wasp, Quantumania coming out, Little Mermaid, Guardians Volume 3, that's Guardians of the Galaxy, Indiana Jones, I love Indiana Jones, in June. I can't wait for that movie. I'm a big fan. And then Haunted Mansion, like a little Disney Haunted Mansion movie, kind of like what we've been doing with that river trail thing. I don't remember what it was called, with The Rock and things like that. So pretty cool there. And then Disney Plus slate, we got The Mandalorian Season 3. That's going to be a big moneymaker. I can't tell you Baby Yoda is probably responsible for at least $1 billion worth of sales for Disney. Just Baby Yoda alone, responsible for at least $1 billion worth of merchandising sales for Disney. And that's great. Okay, then we have the Ahsoka season 1, Loki season 2, Peter Pan and Wendy. I think that's a good one for kids and for older folks like myself that grew up with Peter Pan. Marvel Secret Invasion, Star Wars Skeleton Crew, and X-Men 1977. And then new movie sequels of Toy Story, Frozen, and Zootopia. That was announced on the call, and then you probably saw some advertising for that now on social media sites. But this was the first time you heard this was on the conference call. Okay, The Simpsons is a Disney Plus top performer. Who would have known? I wouldn't have never guessed that. And then ESPN ratings up 8% overall, 14% in prime time. Being selective and right renewals is going to be important for them, especially with the NBA coming up. Hopefully they renew that, but they don't spend too much in that rights renewal with the NBA. Okay. Now, by the end of the calendar year, the board will be hearing a proposal to reinstate the dividend. Okay. That's a good thing. That means you make a quarterly dividend. I remember when the dividend was there, I wasn't an investor in Disney, but it was $1 a share. So it's nice to get $1 per share, kind of like I do with an NXP, kind of like I used to do with Wynn Resorts. Really nice to get that dividend back in that day. I would rather they use that money to help grow the platform or make better content to appreciate the stock. So for Disney, I mean, great to have a dividend. Not a must for me as a shareholder. Definitely not a must. Okay. Now, the board has established a succession planning committee. Okay. Because Bob Iger, again, 72 years old for Bob Iger. Okay. This guy's no spring chicken. Okay. He doesn't have all the time in the world to work for Disney and just die while he's on the job. He wants to go home, be with his kids, his family, and live the rest of his life in peace. Definitely don't blame him for that. He's been a CEO for 15 years, 2005 to 2020. They need to have a good plan in place. I'm glad that they have a committee of this going forward. Now, real quick, okay, parks and experiences. These are highlights from the CFO, okay? So we have 27% revenue growth at parks, 39% operating profit growth with strong margins, strong performance despite reducing capacity on holidays on purpose to maintain guest experience. Park attendance is pacing at the domestic parks, trending above prior year, and the trend is expected to continue. Disney Cruise Line is seeing higher operating income, positive operating income in the existing fleet. That's amazing. And the Wish cruise liner doing just amazing. It's already positive. It's already got positive operating income. It's only been in the seas for a couple months, maybe 3-4 months at the most. Okay, now international parks are growing. Paris specifically is doing extremely well because of the Avengers campus and an Avengers themed hotel in Disney Paris. I didn't know about that, but that's new that I found out. Pretty nice. And then higher royalties from Tokyo Disney. Okay, but Disney Shanghai, man, they should just close Disney Shanghai. I would not shed a tear if Disney closed Disney Shanghai. All right, now media and entertainment, that's Disney Plus. They did miss out on money. They lost $800 million decrease in operating income. The ESPN and Hulu subs and annual revenue per user grew due to a price increase in August and October. Remember, when that happens, it means it's harder to gain subscriber growth when you raise those prices. All right, now Disney Plus core subs increased slightly, but then the annual revenue per user decreased slightly, driven by an unfavorable Forex, which is a foreign exchange rate. If you guys see my market alerts, you see that I talk about the value of the dollar, the strength of the dollar, and you might ask, why the heck is he talking about the strength of the dollar? This is why. The stronger the dollar is, the worse it is for companies' revenue, a company's profit margin, okay? So enough of that, but then, of course, domestic price increases do help decrease that annual revenue per user base, all right? Now, recent domestic Disney Plus price increases have been playing out as expected with only modestly higher churn. Churn refers to the decrease in subscribers, losing subscribers. And then the ad tier for Disney Plus is not going to provide any meaningful financial impact until later this year. I think that'll be very positive though when we start seeing it. All right. Now, direct to consumer operating results to improve by about $200 million as improvements in Q1 materialize faster than expected. These are the Bob Iger changes that he's making, the restructuring. So that's going to be positive for direct-to-consumer segment. And then ESPN ad revenue down, but only because they had 2 fewer games for NCAA football due to some time and weather changes. All right. The NBA deal, we talked about that. They need to be more selective. Hopefully they don't spend a lot of money on that. Now, in conclusion, the focus on profitability is exactly what we needed. It's just a breath of fresh air for us investors in a high Fed fund rates environment. Remember, guys, the higher the Fed funds rate, the easier it is for these stocks that trade on higher multiples to be clobbered, especially if they're not profitable. But once you become profitable, it becomes easier for the stock to go higher when you're in a high Fed funds rate environment. If the federal funds rate goes down, then we can see a lot of appreciation on the stock, okay? The reorganization, cost-cutting initiatives are just what we wanted to see. The Peltz proxy fight, good. It's great news. No longer an issue. But it's sort of the removal of a headwind rather than a tailwind to the stock. So I don't think that's priced in to the name, okay? The sugar high from back in 2021 in the pandemic and when this became a stay-in-home stock because of the Disney Plus segment, because of the direct-to-consumer segment, they got a sugar high from all these subscribers they were seeing coming in, and they're just like, let's just get more subscribers. Don't worry how much we have to spend on them. Let's just get more. That's already a thing of the past. The focus is shifted to profitability. That's exactly what we want, okay? Domestic parks and Disney Paris on fire, no doubt about that. And then making high-quality content is expensive. You have to figure out that balance. Hopefully Bob Iger, just like Netflix has done, can figure out that balance. ESPN spinoff and all that stuff. We talked about that. We'll see what happens. All right, so that's it for today on the Walt Disney Company. I hope that I didn't go too long. It's a 26-minute video, but hit me up on Instagram, YouTube, where I made all my posts. I made some moves this week. Hopefully, you learned something from these videos, all right, and you had some fun. Let me know if I can help you with anything. Peace out.